Mr. President, there's no doubt that the last 8 years were not good ones for the American economy. Yearly economic growth under the Obama administration averaged just under 1.5%. That's less than half of the growth needed for a healthy economy. And that kind of weak growth has consequences: fewer jobs, fewer opportunities, and lower wages. Wage growth was almost non-existent during the Obama administration, and new jobs and opportunities were few and far between. There have been a few encouraging signs since the election. Both wage and job growth have shown some improvement, but we are still a long way from getting our economy back to full health. The GDP report for the first quarter of this year underscored the need to implement the kind of pro-growth policies that were lacking during the Obama years. One major way to spur economic growth and improve the health of our economy is to reform our nation's tax code. Our current tax code is strangling businesses both large and small. Our nation has the highest corporate tax rate in the developed world, putting American businesses at a competitive disadvantage in the global economy. Small businesses and family farms face high tax rates, at times exceeding those paid by large corporations. These tax policies have consequences. A small company that owes a large tax bill to the federal government is unlikely to be able to come up with the capital necessary to expand the business or to hire new workers. And when American businesses are taxed at a far higher rate than their foreign counterparts, it's likely to be the foreign rather than the American companies that expand and thrive. Tax reform needs to address these obstacles to growth. Later this year, the Senate plans to consider a major tax reform package. Two of the most powerful tax-related things that we can do to increase economic growth are lowering business tax rates and allowing businesses to recover their investments in inventory, machinery, and the like faster. The Senate tax bill will do both. Today, I introduced legislation that I hope will be a part of the final tax reform package here in the Senate. My bill, we're calling it the Investment in New Ventures and Economic Success Today Act, or the INVEST Act for short, focuses on helping small and medium-sized businesses by allowing them to recover their costs faster. Mr. President, earlier this year, the Economic Innovation Group released a report on economic dynamism. Economic dynamism, as the Economic Innovation Group defines it, refers to the rate at which new businesses are born and die. In a dynamic economy, the rate of new business creation is high and significantly outstrips the rate of business death. But that hasn't been the case in the United States lately. New business creation has significantly dropped over the past several years. Between 2009 and 2011, business death outstripped business birth. And while the numbers have since improved slightly, the recovery has been poor and far from historical norms. The Economic Innovation Group notes that 2012, the economy's best year for business creation since the recession, and I quote, fell far short of its worst year prior to 2008. Well, this is deeply concerning because new businesses have historically been responsible for a substantial part of the job creation in this country, not to mention a key source of innovation. When new businesses aren't being created at a strong rate, workers faced a whole host of problems. A less dynamic economy, the Economic Innovation Group notes, and I quote, is one likely to feature fewer jobs, lower labor force participation, slack wage growth, and rising inequality. Exactly what we see today, end quote. And again, that's from the Economic Innovation Group. Well, Mr. President, starting a new business always has a substantial element of risk. We don't need to make it harder by throwing up tax and regulatory obstacles. And if we want to see our economy thriving again, we need to be encouraging the creation of new businesses. But our tax code too often does the opposite. My bill, the INVEST Act, would encourage new business creation by allowing new enterprises to deduct a substantial part of their startup costs within the first year. Under current law, new businesses are only allowed to deduct $5,000 of their startup costs within their first year. Any startup expenses above that amount can be deducted, but that deduction is stretched out over a 15-year period. That's a long time. Mr. President, the faster a new business can recover its startup costs, the faster it can establish itself on a secure footing. And entrepreneurs are far more likely to take the risk of starting a new venture if they know they will be able to recover their startup costs quickly. My bill would substantially increase the amount of a business's startup cost that can be deducted in the first year from $5,000 to $50,000. Plus, any additional startup costs could be deducted over a 10-year period instead of the current 15. This would go a long way toward encouraging new business creation and the economic dynamism that comes along with it. A second part of my bill focuses on increasing cash flow for businesses, farms, and ranches, and particularly those that operate as corporations and partnerships, by allowing them to use the so-called cash method of accounting. Under current law, these businesses, farms, and ranches are generally forced to use what's called accrual accounting. Basically, what that means is that a business has to pay tax on income before it receives the cash, and it cannot deduct all of its expenses when it pays the invoice. For a company with inventories, this means it has to deduct the investments it makes over an extended period of time. A small business might have to spend the majority of its available cash on inventory, but be unable to fully deduct that expense until all of that inventory is sold. In the case of some businesses, it might be well beyond the current tax year before that substantial investment can be fully deducted. And that can leave a business increasingly cash poor. And cash poor businesses, Mr. President, don't expand. They don't hire new workers, and they don't increase wages. Well, the INVEST Act would allow businesses to deduct investments in inventory up front, leaving them with more cash on hand to put back into their operations. It would also reduce the need for businesses to employ armies of lawyers and accountants to ensure that they properly adhered to complex accounting rules. Well, finally, Mr. President, the INVEST Act would substantially reform the depreciation and expensing rules. Traditionally, farms and businesses have been forced to deduct expenses like machinery, property, or agricultural equipment over an extended period, anywhere from 5 to 10 years, or as many as 39 years for commercial buildings. Well, that can leave a farm or a business with its cash tied up for years in all the property it takes to run the enterprise. And of course, that means a farm, LLC, or S corporation can spend years without being able to increase its investment in the business or to hire new workers. My bill would permanently allow all businesses to deduct 50% of their investment in equipment, vehicles, machinery, and certain other kinds of property during the year in which it is purchased. It would also help small and medium-sized farms and businesses recover an even greater portion of their capital investments by allowing them to immediately deduct up to $2 million of new investments in business property. And my bill expands current law so that additional building improvements, things like roofs and heating and air conditioning units, would qualify for immediate expensing. Farmers and ranchers who may reach the limit on full expensing are not forgotten either. The bill substantially increases the rate at which they can deduct the cost of tractors, combines, and other machinery. Finally, for those farms and businesses that rely on cars, light trucks, and vans, this bill would substantially increase the amount of their vehicle investment that can be deducted when the business determines, its taxable income each year. Currently, a light truck used on a farm or ranch can cost upward of $30,000. Yet a farmer or rancher is only allowed to deduct around $19,000 of that cost over the required recovery period for a business vehicle. My bill would substantially increase that limit to bring it more in line with real-world costs of business vehicles. These changes to expensing rules all have one goal: putting more money back in the hands of business owners, particularly small business owners, farmers, and ranchers. Forcing business owners, farmers, and ranchers to lock up their capital for 5, 10, or nearly 40 years discourages growth and job creation. Under my bill, businesses, farms, and ranches will be able to redeploy that hard-to-raise capital back into business expansion, increased wages, new jobs, and even new ventures. Mr. President, the Congressional Budget Office predicts that the economy will grow at a rate of just 1.9% over the next 30 years. That is a full percentage point lower than the average growth rate over the past 50 years, which was over 3%, between 3.2 and 3.5. That means that decades of fewer jobs and opportunities, low wage growth, and a reduced standard of living. We don't want to resign ourselves to that, and we don't have to. If we eliminate the anti-growth features of our tax code, if we lift the regulatory burdens facing American businesses and free up businesses to grow and create jobs, we can achieve a future of strong economic growth, the kind of strong growth that will fuel employment and wage growth, along with greater opportunities for American workers. Well, Mr. President, I hope the INVEST Act will help us develop the kind of tax reform that will help us restore strong, sustainable economic growth. And I'm looking forward to working with Chairman Hatch and all of my colleagues on the Senate Finance Committee to put together the final bill and to get it to the President. It is time that we give the American people a tax code that actually works for them.